The Fed's got to worry about A, falling behind the curve and letting inflation get out of control, B, tightening too hard and pushing the economy into a recession. This is a very delicate balance. I think what we've heard so far is they're going to be gradual, but I think they're going to have to speed things up just a little bit because while the inflation picture looks pretty benign right now, the labor market is tightening at an impressive pace. There's a lot of growth in the economy, a lot of support from fiscal expansion. So this is a Fed that I think is going to be turning just a little bit more aggressive than it's currently indicating.
And when James Fuller talks about the risks that being too aggressive could be one force behind an inverted yield curve, he's saying that could happen at the end of this year or even early next year. Do you think that is a real risk?
Well, if the yield curve inverts, it will be because the economy is slowing. But keep in mind that the yield curve is not as good an indicator as it used to be. It long is being compressed substantially by all kinds of central bank purchases, by pension fund demands globally. So normally the yield curve going into negative territory is a sign. It may have to go. It may have to go a little further this time.
Is it a sign in the way that it's correlated, but not necessarily a causal factor, if you will? So does that mean this time could be different? Because it seems to me what you're suggesting is we're in unprecedented times in monetary policy as it is.
Well, yield curve inversion is what happens when the Fed raises short end because it's worried about the economy overheating, long end coming down because it sees a slowing in the economy coming. That process of flattening long end coming down has been helped along by a lot of central bank purchases. I think the yield curve is going to invert eventually. I think it will get there probably in the second half of next year. But it's not necessarily pointing to a recession. It's going to be a significant slowdown. The Fed has to slow the economy to avoid overheating. The labor market is tightening. Unemployment is going well below NAIRU. It's going to have to get it back up to NAIRU. That means they need to slow it.
When it comes to predicting a recession or even just the overall impact on the economy, do you think there's too much weight given to the rate hike path and not enough to the unwinding of the balance sheet? What will the economic impact be in that element alone?
Well, both are factors. The Fed has put the balance sheet unwind on automatic pilot and hopes that this will be paint drying in the background. It is a factor that's going to be helping everything else equal to raise long rates by adding to the term premium. It's not a huge factor, but it will enable the Fed to move more gradually in raising short rates. But bottom line, the Fed has to tighten financial conditions enough to slow the economy to less than supply growth so that the unemployment rate can eventually start to move back up.
So what does that look like in practice with rate hikes? Are you calling for 4?
We think that at the June meeting, there's going to be a bit of a shift, that they'll shift from 3 rate hikes this year to 4, 2 more after the June meeting. And then if the labor market continues to tighten, we could see more next year as well.